I do think that Fed's going to cut. They're going to cut pretty aggressively and persistently.
I think we're going to get a resurgence of inflation.
The underlying ingredients, sure, more inflation. If we don't have a recession, they're in place.
Now, I personally think we are at a major inflection point right now. Welcome to Wealthion. I'm Jared Dillian from Jared Dillian Money. I'm here with Warren Pies of 314 Research, who is also the portfolio manager of the FCTE ETF. Warren, good to see you again.
Nice to see you, Jared. Nice to catch up here.
I think the last time we talked was, it's got to be like 2 or 3 years ago at this point. We did a Real Vision interview. I don't even remember what we talked about. But you're a super thoughtful guy, and there's a lot of, just incredible macro stuff going on in the markets these days. Today is September 11th, and just ridiculous action in the stock market, which we'll get to eventually. Let's just start. Give me a couple minutes of your macro overview, where you think we are today, and then I'll do the same, and we'll kind of take it from there.
Yeah, I'd love to get your thoughts, and hopefully this is more of just an exchange versus an interview. So I'll give you how I see things off the bat here. Yeah, we came into the year, I think in order to understand where we're at, we have to kind of think about where we came from. Coming into the year, it looked to us like most money managers, the consensus, as best we could peg it down, was looking for a weak first half, strong second half for the markets. And that was really going back to, I'd say, election cycle work, which is, I guess it's as good as anything to put a projection out on. But our view is that the soft landing was likely to come into view, or at least be adopted as a narrative for the market. And the first half was going to be a big bull run, and that would force money managers to chase and kind of keep us going here into this, what I would say is the seasonal period of weakness. And so that's what I think is operating in the background right now. The big question, I think the big transition on the macro front is that in the first half, everyone was still worried about inflation. So every time we had a 5-10% pullback in the stock market since 2022, you've seen really it's inflation that's caused it. Inflation pushing rates higher, rates causing stocks to sell off. And I do think around the midpoint of this year, that focus from inflation shifted to growth. And so we had been underweight. The only real change we made in our allocations was that we were underweight bonds through the first half of the year. And we moved them to an overweight on July 5th. And that's where we are right now. We're still overweight bonds. And that's paired with basically a benchmark weight for equities. The reasoning is that now with inflation off the table, you're going to see this kind of traditional negative correlation between stocks and bonds show up, especially on stock sell-offs. And that's what we finally have seen here in the August weakness. And so when I look at it, it really all comes down to the growth question here. And are we going into a recession? And I do think the data is weakening. I think it looks, a lot of things look dicey. We have a framework. Our framework looks to housing construction jobs. And because our view is that you really see about an 8%, at least an 8% drawdown in housing construction payrolls before leading into each moderate recession. And we have not seen those payrolls budge yet. However, when we put our model together that looks into where we're likely headed, unless these lower rates reinvigorate the housing market, I think those layoffs will materialize next year. So our best guess is still soft landing, that we avoid a recession. I do think that Fed's going to cut. They're going to cut pretty aggressively and persistently through the next 6-9 months. And I do think those rates are going to feed into the housing market, into consumer durables. We're seeing things like existing home sales still on the floor back at 2009 levels. New car sales are below 2018 levels. So you see the effects of tight monetary policy in the economy. So as they unwind rates, I think those areas take the baton from other areas, and that's how the soft landing actually plays out. Just last point, I think tactically we said expect to sell off. We even even back in July we said we expect to sell off between August and October. It's actually normal to see a 5 to 10% drawdown in the markets in this window in the years where you have had a 10% first half of the year, and then you end up with a pretty strong seasonal chase, which would be in the post-election period. So I'm looking for a post-election rally. The thing that bothers me the most about that roadmap is it is pretty consensus from what I hear. So always makes me feel uncomfortable to be with the consensus. The one last thing I know, last time we talked was really about oil, and that's what a lot of our clients look at. The big prediction we had, which is actually kind of playing out, is that we would hit $90 a barrel on Brent around the end of Q1, and that at the very end of the year, we thought oil had downside to as low as $55 a barrel. And so to me, this oil weakness is really about the struggle to digest those OPEC barrels and not so much about recession. So that's my 40,000 foot view. What are you seeing?
Well, let me just bounce off some of the stuff you said. The key thing is, you had said that you had predicted that the market would be first focusing on inflation and then focusing on growth, and then we would get negative correlation between stocks and bonds, which, like you said, is happening. You said you're overweight bonds. I personally think we are at a major inflection point right now with these growth worries, right? Um, I do think that oil prices have a lot to do with growth. I mean, they are obviously they have to do with OPEC, but I think it has a lot to do with growth. If you look at commodity prices across the board, just pick a commodity, with the exception of gold, which is not really a commodity. They're all on their ass. Like the commodities basket. If you look at the index, if you look at like the Bloomberg Commodity Index or anything, it's on the lows. Had a 15% drawdown. Um, just sitting in my computer and staring at the screens and watching the price action, it feels like we're getting close to capitulation in this growth scare trade, right? I think we're very close to a bottom in oil. I think we're very close to a bottom in a lot of commodities. I think we're very close to a top in bonds. I think this is literally playing out as we speak. You talked about the Fed. Um, you mentioned that the Fed's going to cut aggressively, but I think we're going to get 25 basis points for the first cut. That seems to be pretty priced in at this point. If we got 25, 25, 25 for the rest of the year, that's a little less than market expectations. So the market will have to recalibrate that and might lead to some risk off. I'm not super bearish on stocks. I think we have support somewhere in the neighborhood of 5,300 in the S&P. What the plan that you laid out for stocks is actually pretty close to what I was thinking. And I do think we're going to get a soft landing or no landing. I don't think we're going to get a recession or a severe recession. Um, and right now, the market is trading. I mean, if you look at positioning, the commitment of traders data across a whole bunch of commodities, we are at record shorts. We're like at record short positions, like the lowest net long positions. And the market is trading like we're looking at short positions that are more extreme than the financial crisis or the European debt crisis or the pandemic. Like that's how short the market is positioned in commodities. And I think a lot of it has to do with this growth scare. So back to you.
Well, I don't look at every commodity, but I look at oil quite in closely. And I've been saying I think we aren't going to go straight down in oil for sure. My view is that we're going to bounce here. Really, like you said, hedge fund managed money on CFTC disaggregated data. We look at it on a percentage shorts as a percentage of total managed money open interest is at, like you said, 36%. You just don't get that high except at very close to market bottoms. I think just to be technical to trade the market, you want to see those positions start to reverse. So you want to see those come down to really trigger a buy signal, like a layup type buy signal. But we're in that neighborhood where we should be watching for that. And then gas oil, managed money position in gas oil, so middle distillate refined products, is net short. And that only happens like 3 or 4 times going back in the full history of this data series of the positioning, like you said. So, and it's the deepest net short that we've seen since late 2015, early 2016, if you remember that brutal sell off in crude oil back then.
Yep.
And so that it all aligns with what you're saying. And my view on bonds, our view on bonds, was that this rally would take us to about 3.5 on the 10-year. When you look at soft landings, that usually the bottom occurs, the absolute bottom in yields occurs right around, right after the first cut. So we're looking for that yields to bottoms, bonds to top, as you said here too. So, we've been playing that trade for the last, I don't know, 80 basis points or so on the 10-year, and looking for that looking for an off ramp on that trade too. So yeah, in one way I look at it as a rule of thumb on the 10-year is that, what is it? What are we pricing in at 3.5 on the 10-year? I think we're getting close to recession level pricing. Normalized, the 10-year trades at about 140 basis points spread to the Fed funds rate, over the Fed funds rate. So once the Fed's done cutting, basically from a 3.5 10-year, you're kind of saying the Fed's going to take the funds rate down to 2.25 maybe percent, which is aggressive and above most terminal rate estimates that you see out there right now. And so you're really seeing a 10-year, once you get to this neighborhood, that has fully priced a cut cycle in. And so people might be saying like, well, why are you sounding so bearish or negative on bonds? Because I think you have to keep a cyclical view separate from a secular view. And I think when you look at the secular view of bonds, you're going to want to have more periods where you're underweight bonds than overweight. But when these growth scares are happening and they're intensifying, you want to be able to kind of identify them in advance. And that's when bonds will actually provide some positive action for your portfolio, for your mix of assets. So I'm with you on a lot of that stuff. I think we should be watching for inflection points across all those cross markets.
Yeah, the way I look at this is, we have had economic weakness. So the PMIs have been negative for like a year, right? So all the PMIs, all the surveys have just been terrible for a long time and hasn't really been a good signal. The labor market has been weakening. You know, honestly, the last payroll print was not terrible. It missed by 23,000 jobs. The unemployment went down. Unemployment rate went down. The average hourly earnings went up. Like, it was kind of a mixed payroll report. I wouldn't characterize it as catastrophic. What I think we're seeing in the labor market is normalization, right? So what happened was, during the pandemic, we pumped all this stimulus into the economy and we created all these labor shortages. You went to a restaurant and it was half closed because they couldn't find people to work, had all these labor shortages. 4 years later, you're finally starting to see the labor market normalize into something like what it was before the pandemic, right? That's really all this is. And people are misinterpreting this data to mean, okay, payrolls are getting worse, therefore we're going into a recession. It's just normalization. That's all it is. So, um, you talk about the tens at 3.5. I think they're at 3.7 right now or something like that. I think that is grossly mispriced, right? Grossly mispriced. And if you look ahead past the election to whoever gets elected, whether it's Trump or Harris, um, it's going to be inflationary. Like, no matter who gets elected, it's going to be inflationary for sure. So, yeah, I mean, I actually, I haven't really been looking at tens. I've been looking at 30s, and if you look at 30s at 3.9 or 4%, that to me seems grossly mispriced. It is ridiculous. I stare at the screen and it mocks me every day. So
I mean, I have a lot of friends. So like I've been in pretty big bond bear for a while. We were long for a little bit when they got to 5, and then we got off that, went underweight again November of last year, probably a little early. I think the yields kept going lower after we made that move, but nevertheless, we've been bond bears, and have done a lot of work on the deficit situation and how non-Federal Reserve issuance that's going to have to get digested by the market during this QT period and all these different things. But I just think that once growth becomes the dominant factor in the market, you get a reflexive move into fixed income. And some of these valuations, like, yeah, they matter over the long term. And I think it's good for us to intellectually understand that this 10 years pricing in quite a bit. It's probably pricing in a recession at this point in time, or very, very close to it. And so, if you don't think there's a recession coming, then you're probably getting close to the end of this move. I
Yeah.
still think there's going to be a solid, I don't think it's going to that the growth scare is just going to lift all at once. I think it's going to be a process for a bit. And so I don't really I'm not fearful. I'm not wanting to short bonds here. Like, I think there's a lot of people who want to jump on shorting bonds, and I just think it's early for that. I do think inflation will come back, like you said, but I don't think it's coming back um, in the numbers, which is what the Fed cares about. So that's all I should really care about, in the numbers for another year or so.
Yeah.
So that's to me is my rough timelines. We're going to let the Fed cut. We're going to have this kind of Goldilocks period. Who knows how much the market front runs all that, and markets and economies can diverge somewhat. But yeah, I'm not worried about. I'm not going to think about shorting bonds, even though there might be an opportunity here or there, until I think inflation. I still see, once I see evidence that inflation is ticking back up, and then I'll be looking at that.
So one of the things when you mentioned is construction jobs. Um, what if the construction jobs data is bad? What if it's giving you a false signal? Okay. So if you take a chart of home construction, actually, let me do it this way: home construction is going like this, and construction jobs are going like this. Like, what if the data is bad because 10 million people came across the border and they're being hired in the construction industry, and they're not being reported, they're being paid off the books, right? Like, when I look at those two charts, so at home construction and construction jobs, it's the only explanation that I can find, because there's a massive divergence there. And so if you're looking at construction employment as a leading indicator of the economy, and you say, okay, construction employment is flatlined or going down, like, I I just think there's a possibility that the data isn't good, that it's unreliable. So
I mean, it's possible, and it's probably happening. I mean, but I think that's probably been the case through all of history, is that there's just a lot of off the books construction labor. I mean, whether it's Mexican labor or now more like South American labor coming through Mexico. I think that's part of the market. It's in the market, and you just have to. I personally think you just have to work with the ingredients you're given. And to me, it's possible, but we haven't really seen it before. It's worked. It's worked in every other cycle. I'd be hard pressed to imagine that it's skewing the data entirely. The thing my read on it is actually that payrolls are stronger than they should be, given construction activity. So like units under construction for multifamily and single family are now falling. Multifamily has been falling for like a year and a half. Single family is now rolling over. Our model says that the residential construction industry needs about 900,000 employees, given this kind of workload. And we're still at 950,000 employees. So our model is saying, hey, there should be revisions to this data downward or layoffs imminently. And that would get us right into that recession neighborhood. So that's why I'm on this. I'm nervous about it. That's what's making me nervous, is looking at this backlog of projects that's starting to bleed lower, and saying, hey, I mean, can this support this many workers? And my feeling is that if mortgages get down sub 6%, which looks like they're going to, builders then can buy down mortgages to sub 5%. I think that's enough to keep the plates spinning. for a bit longer. And I also think if you look at our model, we were saying for years that there are basically not enough workers to support the workload. So back just 2 years ago, our model said, look, the industry is short 80,000 employees. So we've gone 130,000 job swing there. And I think that those days, it's been a tight construction labor market for many years, maybe the last 10 years been extremely tight. And I think that the employers remember that, and they're going to be slow to let good laborers go. The ones that show up on your books for sure. Forget the off the books guys. But so that to me is the underlying issue that I see, is that we're starting to see units under construction come down, and I really do think we need to see activity pick up to support the amount of workers on the payrolls.
Getting back to inflation for a second, I said that I think that 2025 is going to be a resurgence of inflation. I'll say it more specifically. I think we're going to get a resurgence of inflation. There's some people on Twitter who post those charts, like the overlay with like 1969 to 1982, like the big waves of inflation and stuff like that. And here we are, sort of in the trough of inflation. I don't really like overlay charts. I think they're kind of dumb. It kind of absolves you of thinking. So I'm not bullish on inflation because the chart says it's going to go up. I think whatever policies we get out of DC are going to be inflationary. But one thing I will say about inflation is that I spend a lot of time thinking about the psychological component. Okay, so we still have an inflationary psychology. Like, people believe that inflation is high, and there's a whole discussion about that because people confuse the level of price with the inflation rate, right? So people go to the grocery store and it costs $300 to buy groceries, so they think that inflation is high when it's not. So when you have an inflationary psychology, it causes people to act in such a way that perpetuates inflation, right? So they buy more often, they buy early, they buy large quantities. And I still think we haven't broken the inflationary psychology in the way that Volcker and the recession of 82 did, right? The Fed did a lot. Powell raised rates faster and higher than Volcker, right? The Fed was very aggressive. They were late, but they were very aggressive. I don't think it was enough to break well, in 1982, we had negative 6% GDP. We had a terrible recession, right? And that was enough to do it. And we never really got that. I mean, 2022 was a tough year. Like, stocks and bonds were both down 20%. But we never really got that deep recession to break that psychology. So I think it's coming back. I think inflation is coming back.
Do you have a timeline on when you're expecting that to start showing up in the data?
Probably middle of next year.
Yeah, and do you expect that to be more of like core inflation or commodity based inflation, or maybe both?
Both. Yeah.
Yeah, I mean, I think I'm sympathetic to the view that inflation is not dead. I don't think it is dead, basically the reasons you laid out, which is, there's a phrase, what did Milton Friedman say? Inflation is always and everywhere a monetary phenomenon. And I remember tweeting out, I thought I was clever for a minute, that inflation is always and everywhere a psychological phenomenon. So I agree with you that there's a psychology to it. I do also think that if you were trying to get down to brass tacks, like what's causing the inflation we've seen, there's been like this big debate over these years. Is it supply chain from COVID, spending? I think if it was, we can all think about it. It's kind of silly to say it's just the supply chain at this point. Because if you had a supply chain with no demand side stimulus, you would have had prices go up, and the level, like you said, would come back down to where it was pre-supply chain disruption. And what we've seen across the board, think about houses in your neighborhood, car prices, whatever, prices just leveled up and then stayed there. And everyone kind of knows, to your psychology point, that they're not coming back down, that was like a one-time shot in the arm of crazy stimulus where we went off the rails and just injected money straight into the system. And so I think that the ultimate genesis of inflation is the deficit. So we're running a 6% deficit in the middle of an expansion. We've never done that before. Pro-cyclical deficits this large are we've never experimented in this way. It really is an experiment, and so you have to be open to a wide range of outcomes. And I do think that while that deficit is that large and the economy is growing, we should be expecting inflation to um, kind of bubble back up. I just guess when I look at the timing of everything, the way the BLS and the Fed looks at timing of inflation, it's a lot about base effects, like you said. It's like the level's already baked in. Now we have to have increase from that level in order to trigger inflation. And I think we have pretty tough seasonal comparisons, or pretty good seasonal comparisons, depending on how you're looking at it, going through the first 4 months of next year. I also think that oil is a tailwind. I think OPEC needs to get that oil back. So that's like 200,000 barrels a month. That's set to start coming back at the end of this year. So that comes through next year. So I see that as like a cap on the price of oil. And so I probably think we have a little bit longer to go before we get that re-acceleration of inflation. That would be my personal view. Probably another year from now before we start looking out for it. But hey, I could be wrong on that. Like I said, we're in uncharted territory. But I agree with you that the underlying ingredients, sure, more inflation. If we don't have a recession, they're in place. They're in place.
Now, you talked about stocks and seasonality, and to be perfectly honest, I don't pay any attention to seasonality at all. I call it farmer's almanac kind of stuff, and I kind of piss all over it. Like I don't. But you've obviously spent a lot of time looking at historical data, and you said that if the first half of the year is good, then you usually get a pullback in August to October, and then you rally towards the end of the year. That actually seems like a pretty good scenario to me. Um, so
I think so. I would try to convert you to seasonality, because I was a big seasonality skeptic for years too. Like I thought it was like just simplistic, and why would this happen? And I think a lot of it is goofy, to be honest. The idea that you could pick like a single day out and be like, this is the best day of the year, this is the worst day of the year. That's kind of random noise. But I do think, as I've gone down the path of honestly running a business where I talk to so many different money managers, and what I realize is that everybody's judged on the calendar year. So a lot for many people in this industry, your life is basically over on December 31st if you underperform. And that causes distortions in behavior, and I think it does show up in the data. And so we combine a couple things. We look at strategist forecasts, and we've done a bunch of back testing, so quantified it. When the market is above the strategist year-end target, it's a good time to be long the market, because it means that there's not enough optimism. There's a chase going on amongst strategists. And that's been the condition that's been present through this entire year. So strategists coming into the year, they had their year-end 2024 forecast implied a 1% gain
yeah,
for
it
the
was pretty much flat. Yeah.
yeah. And so when you go back in time, like the beginning of the year is when the optimism should be at its height, where they should be upping those forecasts and giving you that, it's 8%, it's career risk. They all want to be like in the year 8% higher, because that's the average year. Well, this year they said 1%, and the first half was particularly weak. So when you have a strong January, I do think the January effect is real. You talk about what Stock Traders Almanac stuff, like that was the old rule of thumb, the January, I think it was January effect or barometer or whatever. I think there's something to that. Once the first of the year starts out strong, anyone who's underway is perpetually behind the market as it rallies. And you just have these dips are bought shallower and shallower. And then the end of the year gets here, and everyone looks at November and they say, look, all this money is going to get rolled over and reinvested in as we rebalance at the end of the year. There's that, and that helps feed the seasonal tendency. And so I have to leverage my bets and try and catch up if I'm down. And you see that, like, there's like a hockey stick higher in the data once you get past October in these years where the first half of the year is positive. So, I'm not going to say that phenomenon will overpower the economy. For instance, like if the economy rolls over, who cares about seasonality? 2008, the whole sell off was in the teeth of this strong seasonal period. But if you're not having a recession and the Fed's cutting rates and it's kind of just steady as she goes, then that phenomenon of people who are behind after a strong beginning of the year is going to take hold. So I think it's really important to see how low we get during this seasonal weakness period, whatever you call it, this pre-election volatility period that we're seeing right now. If you don't get lower lows than what we've already had, even lower than that, I think that this structural move, the seasonal chase, is in play. And so that's kind of what I'm looking for. Clearly, again, just to be 100% clear, in the hierarchy of things that matter, the economy, if it starts rolling over, it's not going to, this whole thing is not going to matter. But if we avoid the recession, like I think, then I'm these dips are going to get bought. You're going to get money forced into the market. Career risk is a real thing. And so that's been my conversion. It's been looking at the data. Also, what I'd say is look at the months where the stock market forms major tops. December and January are like 60% of all major tops in the market for the year. And so if you have a bad January, if you go high and then fall apart in January, that's generally portends negative things for the rest of the year. And if you're having a strong January, you generally will continue higher until December of that year. These are all just general rules, and of course, there's exceptions for everything. But I think it's real. I'm a con.
Cool. Last thing I want to talk about is gold. So I've been long gold since 2005. It's been the biggest position in my portfolio for 20 years almost. And a couple months ago, when it got up to about 24.50, I cut about 2/3 of the position. I was 2,500 was a big round number. I was a little nervous around there. And just in terms of looking at the short-term price action, every time gold gets to 25.30, it gets rejected. Every single day it gets up to there and it gets rejected. So the way I'm looking at this, and gold, as you know, trades very technical, right? There's really, like, the fundamentals matter far less in gold. I mean, the supply and demand, who gives a crap? It just doesn't matter. It's really about technicals. So the way I look at this is that if we break through 25.30 decisively, I'm going to reinitiate that position in gold and I'm going to ride it higher, right? So, what are your thoughts?
Yeah, I'm with you. We thought that gold was going to get to $2,500 an ounce this year. That was like our official call back last December. So that was a nice move we've had. But like you said, so like we've tried to model gold, and I say modeling gold is like nailing a jellyfish to a wall. It's just it's hard to find a consistent driver. So we lean real heavily on technicals. So I think you're right on. And one of the things I've noticed with gold is that it has this tendency uh, to, and this is on a lot of different time frames. I noticed this, to do what you're describing, where it stalls out and in basis for a long time. And we saw that really post pandemic. We were like 1680 to about 1950 or so for years, just this wide range. And then you break out, and once gold breaks out, especially on these more multi-year time frames, it has a tendency to just kind of go parabolic, and you don't want to even put a you just want to let the thing run, is the way I look at it. And so I think that's where we're at. I think we've moved into a secular bull market for gold. I think that the basing period that we went through post pandemic is over, and gold is kind of the reciprocal of trust in institutions, and trust in institutions is in a secular bear market. And so therefore I think gold will be in a secular bull market for all the reasons we just laid out, that we have
Yep.
basically structural deficits that we've never seen at this stage of the business cycle. So that's a form of debasement, whether it shows up in the official CPI data or not. It's debasement, and gold wins. And then the Fed starts cutting rates in the face of that. You see the dollar starting to go down. Everyone in the world needs the dollar to weaken, really. I mean, it's bound to happen. And I think that like Trump will basically come around and say it, but everybody, even probably Harris, wants the dollar to weaken somewhat. So, I think gold is the most logical beneficiary of that.
Well,
I agree.
before we get going, let's talk about the dollar for a second. So technically, the dollar sold off for a couple of months. It put in a low. It's been kind of bouncing around the low. Um, I also think the dollar should get weaker. I think the dollar should make lower lows, which obviously fits in with my commodities thesis. You know what I mean? Thoughts on that?
I'm with you. I mean, you look at like a purchasing power parity basis, the dollar's overvalued.
It is it is vastly overvalued. Like, look, like we have, you know, I'm on Facebook. Like all my dopey high school Facebook friends are like traveling in Europe this summer. Like, look how cheap it is. Like, it's I don't know if you remember this, but the exact opposite happened in like 2005, 2006 when the dollar was very weak. We had all these foreigners, all these French and Germans and British like hanging out in Times Square. I was working in the Lehman building in Times Square and like nobody was speaking English. It was all these tourists, like you can tell when purchasing power parity gets out of whack.
Yeah, everybody's skiing in Japan. They're like, it's cheaper to ski in Japan than Colorado, So, yeah, no, I mean, I think it's a matter of time. And it's just to me, it comes down to kind of the Fed is the tightest central bank of the major developed market central banks. And that's one of the reasons I also think that if you overlay a chart of these, it's a coordinated hike cycle. It's going to be a coordinated cut cycle. The Fed needs to cut. I think the more they get out of whack with other central banks, the dollar could strengthen. If the dollar strengthens, then you start having problems with earnings. You could have other things that could be negative side effects. I think the Fed would like I said, everyone kind of is rooting for a weaker dollar. It's starting to create distortions in the system. And so my way of playing that, I think, is gold, number one. And number two, I think it's a low key benefit to earnings. Also, if you get a big hit to the dollar, all these multinational corporations, their earnings look better. And so it's one of those swing factors when you're looking out at forward S&P earnings and you're thinking this market's pretty overvalued and there's a lot baked into it. So, yeah, I'm with you. I'm with you largely. It's a matter of how you express that view. I like gold.
Well, it sounds like we agree on a lot. Probably we're both going to go back to our desks and get our heads caved in. That's usually the way it works out. But thanks for taking 30, 40 minutes with me today and talking about this stuff, and hope to see you around.
Yeah, no, I appreciate the invite and in the conversation, and I hope we don't get our heads caved in. That's all I can hope for. That's like another good day for me if my head doesn't get caved in. So.
Gallows humor. All right, thanks, Warren. See you later.
I appreciate it, Jared.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.